Today we will discuss Unit 1 of International Financial Management, that is International Financial Management and Introduction. Before starting my class, let me first tell the learning objective of my class. After going through this class, we will have an idea of MNCs, how MNCs operate, and we will discuss regarding steps involved in internationalization process, and we will discuss some of the objectives of IFM or International Financial Management. The structure of my discussion will be as follows. First, I will give an introduction to IFM, then we will discuss regarding MNCs, then we will discuss steps in internationalization. Next, we will discuss IFM and its objective. I will summarize my discussion. We will discuss some keywords, then some self-assessment question and further readings. Friends, you might have seen many products which are produced in other countries and you are using it. Let's take an example. I am writing with this pen tab, and this pen tab is produced in China. You might have seen some of your TVs might be produced in Korean, like LG, Samsung, etc. etc. The mobile phone you use are Apple or any Chinese made mobile phones. Nowadays, countries are using products which are produced in different countries. We are using product. Now a question arises, can't we produce all these product in our country also? Yes, we can produce. Can't we produce the mobile phones which are produced in China, in India also we can produce? But why we are using Chinese made mobile phones? Why we are using US made jeans? The answer lies in the theory of Adam Smith and David Ricardo. Adam Smith and David Ricardo has given the first theory of international business. They have identified the basis of international trade. What should be the basis of international trade? As per Adam Smith, the basis of international trade is each nation should produce or specialized production of those products in which it has absolute cost advantage. David Ricardo tells that a nation should concentrate on producing that product in which it has a relative advantage. What is absolute advantage or relative advantage? Tells that the resources available with a country is limited. A country cannot produce all the products which its citizens are using. So a country should concentrate on production of those products in which it has absolute advantage. It means in which it can produce the product at the low cost. It should produce that product and it should export it to other countries. And it should import those products which it has a relative inefficiency. So Adam Smith has given absolute cost advantage theory of international trade, and David Ricardo has given the relative cost advantage theory or comparative cost advantage theory of international trade. As per these theories, each nation should specialize in production and export of those goods which they have highest relative efficiency, and they should import those goods in which other nations have higher relative efficiency. Now we will discuss some of the events which have occurred over 100 years, past 100 years, which has laid the foundation of international business or international trade or international finance. The first important event which has occurred is the shift of the world from bimetallism to classical gold standards. Now, in case of international business, we need an exchange and medium of payment. Previously, it was barter system. It was bimetallism. You give me rice, I will give you petrol. That is barter exchange of international trade. Then the countries have shifted from barter trade to classical gold standard. Gold was used as the medium of exchange. And this classical gold standard started from 1914 and it lasted up to 1920s. Then comes the First World War. There, the classical gold standard was abandoned for some times. Next comes the Great Depression of 1929. Next, at that time, also the classical gold standard was abandoned. Next, the gold standard was again restored in 1936. Next, World War II comes. Once the World War II comes, the international trade was hampered because most of the worlds were destroyed by the ill effect of World War II. Next comes a system where the international trade was restored, that is known as Bretton Woods system. In case of Bretton Woods system, the US gives guarantee that the international trade will be done in two cases, with the help of gold and with the help of dollar. And US government has given guarantee that anyone who brings dollar to him, they will exchange it with gold. So with the help of Bretton Woods conference or Bretton Woods system, dollar is treated as the medium of international trade. And this US government has given, US Fed has given guarantee that the US dollar will be converted into gold at a predetermined exchange rate. And this Bretton Woods system lasted up to 1972. And in 1972, the US government denied to convert the US dollar into gold. So this system collapsed. Thereafter, the free float of currencies between the countries exist. Then there is oil shocks. Then there is oil shock in the world. The oil prices has crashed drastically. Then there is the problem of inflation in developing countries. There is sovereign debt crisis, inflation in developed countries or advanced economies in 1980s, fall of Berlin Wall, then the fall of communist regimes in East European nations, then these East Asian countries crisis, rise of East Asian countries like China, India, Mexican crisis, Russian oil crisis, and at last the global financial crisis. These are the things which saved the international financial management. So all these development has saved the international finance, and as a result of which the certain mechanism of IFM, International Financial Management, has developed. These are certain mechanisms which are developed under IFM. First, there is establishment of unified market determined exchange rate. What is unified market determined exchange rate? The exchange rate is developed through a market mechanism under free float regime. The exchange rate is determined under demand and supply of currencies in the forex market. Many countries has introduced CAC. What is CAC? Current account convertibility. They convert their currencies freely under current account transaction, and gradually they have moved from current account transaction to capital account convertibility. Some countries has adopted fuller capital account convertibility. Some countries has adopted partial capital account convertibility. There is a reduction of import duties. Countries have tried to reduce the import duties. They liberalize the investment FDI rules so that more and more countries will more and more foreign investment will come to their country. There is increase in import and exports. There is coming down of trade barriers. Trade barriers are of two types: tariff barriers and non-tariff barriers. Countries have drastically reduced the trade barriers so that what will happen? There is free flow of goods and services between different countries. There is establishment of multilateral bodies like IMF, like WTO to resolve the trade disputes. All these things, all these developments has brought IFM, the importance of IFM to the picture. Next, we will discuss some of the reasons for emergence of IFM. What are the reasons of emergence of IFM? Before discussing that, we will make a difference between IFM and domestic finance. What is the difference between IFM and domestic finance? Difference between IFM and DFM. The main point of difference between IFM and DFM can be discussed under three broad headings. What are the three broad headings? One is foreign exchange, another is political risk, another is market imperfection, another is expanded opportunity set. First, we will discuss forex risk or foreign exchange risk. Under domestic financial management, one has to operate in one currency. But if you are a multinational corporation, you have to operate in multiple currencies. Your inflow and outflow will be in different currencies. And the value of these currencies fluctuate under floating exchange rate regime. Suppose you are an importer, you are importing and making payment in dollar. If the dollar price increases, what will happen? Your outflow of money will increase, your expenses will increase, and your incomes are coming in rupee and your outflow will be in dollar. So you will facing a problem of foreign exchange risk or forex risk. Who face a forex risk? Forex risk is faced by those corporates whose inflows and outflows are in different currencies. If your inflow is in dollar and outflow is in dollar, you do not have any forex risk. But if your inflow is in dollar but outflow is in rupee, or your inflow is in rupee, outflow is in dollar, in that case you will face a risk that is known as forex risk or currency risk. In case of domestic financial management, there is no concept of forex risk or currency risk, but in case of international finance, there is scope for forex risk, currency risk, or exchange rate risk. Next, second is political risk. What is political risk? The multinational corporates has to operate in different political regimes. There is change in tax laws in different countries. There is a case of repatriation of profit policy. You will do business in a Qatar and you will earn profit, but you cannot take back the profit due to the Qatar's repatriation policy. Repatriation means taking back the profit back to home countries. There is a concept of withholding tax. There is concept of royalty. There is outright expropriation problem. What is expropriation? Outright expropriation, that is nationalization. You are investing in a country, you are doing business, one fine morning, the government may tell that this particular business is nationalized, you take back this money and go away from my country. That is expropriation risk. In case of international finance, there will be political risk attached to your inflows and outflows. This is the difference, which in case of domestic business, it is less. Then next is market imperfections. What is market imperfections? Market imperfection arises due to misallocation of resources. Once there is misallocation of resources, there will be market imperfection. And this problem is not there in case of domestic business, but it is accelerated in case of international business. Next, expanded opportunity set. What is expanded opportunity set? This we will discuss. We know that the domestic business face certain constraints. They have a constraint in relation to raw material. They have a constraint in relation to financial availability. They have a constraint in relation to availability of quality manpower. But all these constraints can be addressed by multinational corporation by operating in wide areas. So these constraints are resolved in international business by MNCs. So we have discussed the difference between domestic financial management and international financial management. Now we will concentrate our discussion upon a concept that is known as MNCs or multinational corporation. Multinational corporations are the backbone or foundation of international business or international finance. So first we will discuss what is an MNC. What is a MNC? An MNC is a company incorporated in one country but has production and sales operation in many countries. It is started in one country, in home country, but it has operation throughout the world. It operates in many countries. Let's take an example. Apple is a company. It has incorporated in US, but it has place of business throughout the world. Pepsi is a company incorporated in US, but it operates in 181 countries of the world. This is known as multinational company. They are incorporated in one country, but they produce in different country. They sell in different countries through their network of affiliates and subsidiaries. So MNCs may source raw material from one country. They raise finance from another country. They produce in another country and sell in other country. So this is the typical nature of MNC. They take raw material from India, raise finance from Singapore, they produce in China, they sell in US. This type of diverse operations are done by MNCs. So MNCs operate in different countries. So why there is emergence of MNCs? The emergence of MNCs may be due to different regions. One region means large scale deregulation. What is deregulations? Countries are cutting down the license raj, the permit raj. Their countries are inviting foreign players to their own country to do business. You come with your technology, come with your finance, do business here. Now Indian government is providing red carpet welcome to those people, those corporates which will start their operation, which will start their manufacturing hub in India. Make in India campaign. Companies may be in different sectors. They can come to India, they can produce in India, they can sell elsewhere. Indian government will provide all sort of facility to these MNCs who will start their operation in India, who will start producing in India. Then there is substantial reduction in public sector enterprises. Now governments think that government's business is not to do business. Private sector will do business. So there is the era of LPG, liberalization, privatization, globalization. India has adopted LPG in the year 1991. From 1991 onwards, we are liberalizing our policies, we are privatizing the sectors, we are accepting money from throughout the world. our companies are doing business in different sectors of the world, and many foreign companies are doing business in India. That is substantial reduction in public sector enterprises and increase in privatization. There is increased development of information technology. This is the main reason of IT boom in India. You can sit here and you can serve the clients of US sitting there. Am I clear? So the increased development of IT has contributed a lot for emergence of Indian MNCs. You talk of Infosys, you talk of TCS. They have global clients. They are operating in Bangalore, but clients are from US, Japan, Germany. Their business is their backends are handled by sitting in Hyderabad, Bangalore. That is possible due to increased development of information and technology. A large number of merger, acquisition, takeover, buyouts are happening in India or throughout the world. With the help of this, the international players are getting a entry to Indian markets. An increase and viable adaptation of free market policies. Now we are in a free economy. We adopted the policy of LPG, liberalization, privatization, and globalization. We are in no more a closed economy. We are a free economy. We are a market-based economy, which invite foreign players to invest here and allow our companies to go and invest outside. You talk of Jaguar Land Rover. Tata has acquired Jaguar Land Rover and doing business in UK. UK companies are doing business in India. We are in a globalized world where each and every economy are interconnected. So this is the evolution of MNCs. Now we will discuss some of the advantages of MNCs. What are the advantages faced by MNCs? Advantages of MNCs. Now please see, when MNCs operate, what advantage is created? First, MNCs operate in a large scale, in a global scale, as a result of which we get the benefit of economies of scale. What is economies of scale? When you operate in a large scale, per unit cost reduces. As we operate in large scale, we will get the benefit of economies of scale. You talk of Walmart. It acquire garments for the entire world. So the per unit cost of garment of Walmart is damn cheap than the companies which are producing in a small scale. As a result of economies of scale, the MNCs can spread their R&D activities, advertisement expenditure on a global basis. MNCs procure material from global sources. Procurement provides them purchasing power over other suppliers. Then MNCs apply superior managerial and technological know-how. So as a result of which MNCs can provide superior quality product at a cheaper price. They are better equipped for innovation. They can innovate products and provide it to the global customers. You talk of many MNCs, Apple, Pfizer. Previously, the MNCs were coming from US market. Then MNCs are coming from European markets. Nowadays, many MNCs are coming from developing economies like India, China, You talk of BYD. BYD is providing Chinese made electric vehicles throughout the world, electric cars. So it's a message. So now we'll discuss why there is emergence of MNCs. What are the reasons? What are the factors which influenced the emergence of MNCs throughout the world? So we will discuss factors influencing emergence of MNCs. Factors influencing emergence of MNCs. What are the factors? The factors influencing emergence of MNCs can be discussed as below. First, search for raw material. Point number one is search for raw material. MNCs come to those countries where raw material exists. Take an example of steel companies coming to India, especially to Odisha and Jharkhand. Mittal Steel, POSCO is interested in setting up a steel factory in Odisha, in Jharkhand. Why? Because of availability of raw material, because of availability of iron ore, because of availability. Many multinational companies are coming, many manufacturing companies are coming to different countries to acquire raw material at a cheaper rate. If they will import raw material from here and produced in their country, what would happen? The cost of transportation will be high. So, in order to get raw material, MNCs are coming and starting their production base near to the raw material. Second, for the purpose of market seeking. What is market seeking? You know that Apple has started its manufacturing base in India. Why Apple has started its manufacturing base in India? Because it seems that it is saying that India is a growing market of Apple. The per capita income of Indian citizens are increasing, and there is a craze of getting Apple mobile phones in India. So Apple has started a manufacturing base. It has shifted its manufacturing base from US to India. Similarly, Levi's, Stardust, McDonald's, Coca-Cola, Pepsi, Procter and Gamble, Unilever, all of them are seeing a large market in developing countries, especially BRICS countries. So they have started their production base into India near to their customer base. As a result of which they can serve these people, the developing countries, better. Next, third thing is cost minimization. What is cost minimization? Many countries have shifted their production based from developed countries to developing countries like China and India. The main reason is availability of cheaper labor, cheap labor. There is most of the US based garment manufacturer has shifted their operation to Bangladesh because garment industry requires, it's a labor intensive industry. It requires labor, and the labor cost in Bangladesh, Vietnam, it's damn cheap. To get the benefit of cheap labor, to reduce their cost, they are coming to Bangladesh market. So most of the MNCs have their production base in China to reduce their cost. They are shifting their production base from US, UK, and developed countries to China and East Asian countries. They are starting their offshore manufacturing bases to get the benefit of cost of production, to have a lower cost of production. Next one is knowledge seeking. What is knowledge seeking? Knowledge seeking means, you know that Deloitte, Accenture has their base office in Bangalore, Hyderabad, because they know that better quality manpower is available in India. The cost of manpower and quality of manpower is better in India than setting off in developed countries. So these BPO based companies have their production base or have their offices in India because they are getting good quality people at a cheaper rate. So for the purpose of knowledge seeking, most of the companies, electronic manufacturing companies, have their production base in Japan because most of the development in electronic market happens in Japanese market. So in order to get the benefit of R&D facility in electronics, most of the electronic company have their production base in Japan. So this is for the purpose of knowledge seeking. MNCs go to different markets. Okay. Next, we will discuss a concept of steps in internationalization. What steps a company follow when it decide to go to international market? What are the steps normally MNCs follow? We will discuss, have a idea, have a discussion on these steps. Point number one is when a company wants to enter into a foreign market, first it adopt the step of export. It start with exporting. So first point is export. Export is the first point. First, it adopt the route of export. Export means just sell in foreign market. Then once export business is successful, they go for setting of foreign sales subsidiary. They sell their product in foreign market through their sales subsidiary company, that is foreign sale subsidiary. Once foreign sales subsidiary business is successful, they adopt setting of their foreign distribution network. Invest in setting of distribution network, foreign distribution network. So once foreign distribution network is successful, next they go for operationalizing licensing agreement. They give licensing agreement route. Once licensing is successful, at last they go for setting of foreign production facility. Ideally, these are the steps of doing international business. First, they start with export. Then they set up foreign sales subsidiary. Then they go for setting up sales subsidiary and invest in distribution network. Then they go for providing licensing agreement. Licensing agreement means they provide license to different companies different companies in foreign land who will sell on behalf of them, and at last they set their production facility there. These are the 5 important steps. The least riskiest step is export, and the most riskiest step is setting up foreign subsidiaries. And the sequence of these steps indicate moving from low risk and low return to high risk and high return strategy. It means the export route is the least riskiest route and the return on the export route is the least. इससे थोड़ा ज्यादा रिस्की है, you go for foreign sales subsidiary route. इससे थोड़ा ज्यादा रिस्की है फॉरेन डिस्ट्रीब्यूशन नेटवर्क रूट, इससे थोड़ा ज्यादा रिस्की है लाइसेंसिंग एग्रीमेंट रूट, सबसे ज्यादा रिस्की है फॉरेन प्रोडक्शन फैसिलिटी रूट. So gradually the company shift from export route to foreign sales subsidiary route to foreign distribution network route to foreign licensing agreement route to foreign production facility route. These are the 5 stages of international business, doing international business. Next, we will discuss regarding strategies of internationalization. We know that there are 3 main strategies of internationalization. First one is adopting the exporting route. Second one is production in the foreign land route, and third one is providing license. Each route has its own advantage and a disadvantage. First, we will discuss regarding what are the advantages and disadvantages of export route. Export route. What are the advantages and disadvantages of export route? Next, we will discuss advantage and disadvantages of, that is, setting of manufacturing base route. And third, we will discuss the advantages and disadvantages of licensing route. Okay, if you will go for export, what are the advantages? The export route has the following advantage: it's low risky and the profit are low, but here you have a chance of doing mistake. You can learn from the demand conditions of the foreign land. The competitors will be less, and you can expand your operation as per the growing demand in foreign routes. The second one is starting a manufacturing base in foreign land. If you will start a manufacturing base in foreign land, you can provide faster customer care services. You can provide the benefit of research and development efforts to the foreign customer at a quick instance. Next, you can go for a licensing route. If you go for a licensing route, or you will go for a licensing agreements, what will be benefits? If you go for a licensing agreements, your setting, it is an alternative to manufacturing route of doing international business. If you will go for licensing route, you will receive royalties for providing license, and your main inflow will come in form of royalty, and your market entry will be very quick in comparison to production base, and it's less riskier in comparison to production setting of production base in foreign markets. Next, we will discuss our discussion on international financial management. We know that what is international financial management? Financial management is all about managing the financial resources of an organization. If we will go for IFM, we will apply the same concept of financial management to multinational companies. So international financial management is all about managing the financial resources of multinational corporation or MNCs. We will manage the financial affairs of multinational corporation in such a way that the shareholders' wealth of MNCs is maximized. So IFM deals with maximization of shareholders' wealth of MNCs. IFM deals with two important decisions of MNCs. One is raising of funds. Second one is deployment of funds. So raising of funds and deployment of funds of multinational corporations are the scope of IFM or International Financial Management. In IFM, what we will study? What will be the scope or challenges of IFM? In case of IFM, we will understand the interrelationship between environmental changes and corporate responses. We will understand the development and use of new financial instruments like option, forward, futures, swap. We will develop ways to maximize risk management. We'll discuss certain internal and external risk management techniques of multinational corporation. We'll have a balanced view of success and failures of international experiences. We'll discuss how a company can adopt international failures. So ultimately, in case of IFM, we will discuss all these concepts. All these concepts will define the scope of international business. So what is scope of international finance? We will discuss the scope of international finance. In case of scope of international finance, we will study the following concepts. What are the following concepts we will study? First, we will study the exchange rate determination. What is exchange rate? Exchange rate is the rate at which one country's currency is exchanged for another country's currency. The market where it is exchanged, that is known as currency market or forex market. We will discuss something regarding forex market. What is forex market? How it operates? What are the different codes given in forex market? How exchange rate is determined? What are the different regimes of exchange rate? What is fixed exchange rate? What is floating exchange rate? What is managed float? What is dirty float? All these concepts we will discuss under the scope of international finance. Next, we will discuss different theories and practice of estimating future exchange rate. How forward exchange rate is determined. How spot exchange rate is determined. How forward exchange rate is determined. Spot exchange rate means the rate prevailing in today's market. That is known as spot exchange rate. What is forward exchange rate? Forward exchange rate is the rate which market expect to prevail in a future date. We will discuss all those things. We will discuss different type of risk attached to it international business. We have discussed the risk are political risk or country specific risk. The risk are exchange rate risk. The risk are interest rate risk. We will discuss all these concepts in coming classes in international finance. We will discuss various risk management techniques, how these risk, political risk can be managed, how exchange rate risk can be managed, how interest rate risk can be managed. We will discuss. We will discuss how to estimate cost of capital of international business or MNCs. How to estimate the MNC's cost of capital. How to estimate the capital budgeting decisions of international business. Foreign capital budgeting decision. Capital budgeting decision are the decisions related to investment in fixed assets, in foreign projects. How capital budgeting decisions? We will discuss in this concept the APV techniques, adjusted present value techniques of capital budgeting in coming classes. We will discuss working capital management decisions of MNCs. What is working capital? It is the capital required to manage day-to-day affairs of the business. How working capital is decisions are taken in context of MNCs. We'll discuss a macroeconomic view of BOP. BOP means balance of payment. It is a statistical record of a country's inflow and outflow of foreign currencies. We'll discuss have a discussion of BOP, balance of payment. What is the components of BOP? Current account, capital account, error and omissions, and why BOP always balances. And if there is imbalance in BOP, how this imbalance can be addressed, we'll discuss in coming classes, and these are the scope of international finance. Next, we will study regarding certain international financial institutions. We'll discuss regarding IMF. We'll discuss regarding WTO, how WTO frame rules regarding international business. We'll discuss regarding Asian development banks. We'll discuss regarding BRICS Bank. All these financial institutions will discuss, and all these things will constitute the scope of international finance. So let me summarize my discussion today. So what we have discussed till now, over the years there has been systematic efforts to facilitate free flow of goods, services throughout the world. Throughout national boundaries, there is free flow of goods and services. We have adopted a concept of economic integration. We have adopted a concept of LPG. I have told in India we have adopted LPG after 1991. LPG stands for liberalization, privatization, globalization. We liberalize our policies. We invite private players. We move from a closed economy to a open economy. And all these things has developed throughout the world and throughout India from 1991. That is, we have identified a unified market determined exchange rate. We have moved from fixed exchange rate regime to floating exchange rate regime. India has introduced CAC, current account convertibility of its currency. And we have moved from current account convertibility and introduced partial capital account convertibility. We have reduced our import duties. We have liberalized our foreign investment policies. We have integrated the world economy to our economy, and there is emergence of Indian MNCs. We have allowed our companies to tap international financial market to get their financial needs. And we have discussed in international financial market many innovative products have been introduced. Then we have discussed something called with the help of MNCs. I have discussed MNCs are those companies which has set up in one country but they operate in many countries. MNCs draw money, resources, raw material, technologies throughout the world. I have told that earlier MNCs were US based. Next, MNCs come from European countries, Japanese countries. Nowadays, MNCs are coming from developing countries. BRICS countries are producing MNCs. Brazil, Russia, India, China, South Africa. MNCs are coming from these countries. Then we have discussed the process of internationalization of the business. I have told that how companies go or enter into international business step by step. I have told that first they start with exporting, then they set up international operations, then they set up marketing subsidiaries, then they go for licensing agreement, and ultimately they set up their production based there. And they go gradually from low risk return model to high risk return model. Then I have told MNCs has establishing production facility abroad. They can have their own production facility through their affiliate, or they can acquire going concern. They can go for merger and acquisition route. They can go for organic route. What is organic route? Starting their own affiliate, or they can go for inorganic route. Or inorganic route means they can go for M and A route. What is M and A route? Merger and acquisition route. MNCs can adopt a licensing agreement route. They can provide their license to domestic farms. They will operate on behalf of them, and in return, they will provide a royalty to them. In India, McDonald's, KFC, they are adopting licensing route. They are providing license to Indian manufacturer to get to produce product in India and sell in their name, and ultimately provide royalty to them. Then I have told that international financial management aim at maximizing shareholders' wealth of MNCs. And we have discussed what are the important risks associated with international business. I have told regarding the important risks are political risk, exchange rate risk, interest rate risk. These are inflation based risk, different tax laws, multiple market entry risk. We have discussed this, and ultimately how an international financial manager has to balance these risk and return so that it will gain from the internationalization of the operations. We have discussed, and during our discussion we have discussed these keywords. What are the keywords? I have focused my discussion on liberalization. It is one of the key important words of international business. Liberalization means reduction or elimination of control of business. Government's business is not to do business. Government has to provide a facility of doing business. Government has to liberalize the rules, regulation. Government has to adopt the ease of doing business policies. We have discussed liberalization policies. Then MNCs, I have discussed what is a MNC. MNC is a company which has a headquarter in one country, but it has operation base, production base. It operates in several other countries. Then we have discussed subsidiary. What is subsidiary? A parent subsidiary model. MNCs operate under parent-child model. Their home country is parent country, and they operate, through different subsidiary company in the host country. Then shareholders' wealth. This is the ultimate aim of MNCs, to maximize the shareholders' wealth. So, from our discussion, following self-assessment questions arises. What are the questions? Discuss the trends in world economy over last decades. You have to write regarding what are the advances, what are the things happening in last 100 years which has flourished the emergence of international trade. Second question is, how do MNCs come into existence? What is the rationale of MNCs, and what steps MNCs take for becoming global? What are the steps? I have told they start from exporting and they end with starting their production base. All those 5 steps which we have discussed, you have to explain this. Compare licensing agreement with the establishment of subsidiary. You have to compare licensing model with subsidiary model. What are the merits, demerits of licensing mode of providing international business? What are the merits, demerits of setting up a production base and doing international business? You have to compare those things. And what are the risks an international manager face? We have discussed several risks international manager face: exchange rate risk, political risk, You have to explain regarding interest rate risk. You have to explain regarding country specific risk. These are the several risks an international finance manager face. Next, what goal should a finance manager pursue and why? We have told that there are two important goals of international financial management. What are the two important goals? First goal is profit maximization goal. Another is wealth maximization goal. We know that these are two important goals of financial management: profit maximization and wealth maximization. Profit is something which is a narrower concept. A organization should not pursue profit only. A profitable organization, profit is a smaller concept. Profit is a short-term concept. A business cannot sustain for a long period only by pursuing profit. The main aim of any MNC is to satisfy the wants of the customer. Customer satisfaction should be the aim of the MNCs. Profit will come gradually. Profit is a byproduct of customer satisfaction. Profit is a short-term concept. Profit does not consider time value of money. Profit is a shareholder-based approach. So these are the limitation of profit maximization concept. Rather, a finance manager should focus upon wealth maximization concept. What is wealth? Wealth is a market-based concept. Wealth is maximized. Wealth, in case of listed public companies, wealth is reflected through its market capitalization or market cap. Wealth is something which is based upon present value. Wealth means net present value. Wealth is the difference between present value of inflows and present value of outflow. Profit is a short-term concept, whereas wealth is a long-term concept. Profit is an accounting concept. Profit can be manipulated through creative accounting, through inflating the income and deflating the expenses. We can manage profit. But wealth is reflected through market capitalization. Wealth is a market-based concept. Wealth is reflected towards the share price of the MNCs. You can fool some people for some time, but one cannot fool all people for all time. If a MNC does not satisfy the customers, if it is not pursuing NPV maximization concept, people will sell its shares. So wealth is a broader concept. Companies must focus upon wealth maximization rather than profit maximization. Profit can be manipulated, wealth cannot be manipulated. Profit is a short-term concept, wealth is a long-term concept. Profit is an accounting concept, wealth is a market-based concept. So wealth maximization should be the motto of any finance manager who of MNCs. So we have discussed regarding profit maximization and wealth maximization. These are the further readings on international financial management. With this, I conclude my class. Thank you. Thank you for attending my class. Thank you.